One thing I always like to emphasize when I'm talking to real estate investors, especially people using the BRRRR strategy, is that the financing structure at the beginning of the deal can make or break the strategy. So, BRRRR, we all know buy, renovate, rent, refinance, repeat. Most investors focus really heavily on the first three steps, which is finding the property and planning the renovations and then getting it rented. But the refinance piece is really where the strategy is going to pay off. So that step can be significantly impacted depending on how your mortgage is actually set up from day one. So this is where working with a mortgage broker that understands investment financing is going to be really, really important because literally setting up the wrong mortgage for the BRRRR can eat into a majority of your profits. So one of the biggest mistakes I've seen investors make is locking themselves into like a traditional fixed rate mortgage with a standard lender. So we're really not considering what will happen when you want to refinance after renovations, if that's what you're doing. So why is that a problem? Because if you complete your renovation and increase the value of the property in, a couple of few months, you're going to want to refinance to pull out that newly created equity so that you can move on to the next property. If you're in a fixed rate mortgage, though, breaking that mortgage early can result in an extremely large penalty, sometimes tens of thousands of dollars, depending on the rate environment. In fact, a couple years ago, was it 2 or 3 years ago? We had a client, I won't mention the bank because they're still a great bank, but just so happened their penalties were really high. They had a $36,000 penalty to get out of the mortgage. So obviously, they didn't end up selling and doing what they wanted to do. They stayed put because it didn't make sense. But if you're an investor and you're trying to get your money out, that kind of penalty can be devastating. So instead, what we want to do is think strategically about flexible financing options when we're structuring our mortgage from the very beginning. If you think you want to renovate or you may want to refinance down the road, then it's really important to let your mortgage broker know that so we can set it up properly from the beginning. So one option is using a multi-component mortgage product. So there's a few lenders out there that do that. That's where we can look at doing a mortgage, which in this case, you could do a fixed rate mortgage if you wanted, or a variable, because we can do multiple components. So then once the time comes and we're ready to refinance, we wouldn't even have to break the first mortgage. We can just add on a second component behind that first component with the same lender at a lender rate, so great rates, but we don't have to touch anything on the mortgage that we've already arranged. So that's one option. We can do a home equity line of credit that way as well if you prefer a home equity line of credit when you go to refinance and pull out the equity. Maybe you don't want to use the funds right away. You haven't found a place yet, but we want to have access to those funds. So then another option is a variable rate mortgage. So not necessarily multi-component. Maybe we don't fit at a multi-component lender. But when we're doing a variable rate mortgage, the penalty on a variable is only ever 3 months of interest penalty. That's it. So the nice thing about that is we could look at doing a standard traditional mortgage, do the 3 months penalty, incur the penalty, and renovate, refinance, and switch to another lender. It does give us the flexibility if we think we're heading into a downward rate environment. A variable rate is a great option because breaking it for 3 months and then getting a lower rate when we refinance for a 3, 5 year term makes a lot of sense. So these are things that we really want to think about. For BRRRR investors, flexibility has to be more important than squeezing out the absolute lowest rate possible. Any low rate is going to be wiped out by any type of penalty. A slightly higher rate that allows you to refinance easily, pull that equity out, can actually accelerate your portfolio growth because it allows you to move on to the next deal sooner with less costs. So, key takeaway tonight is when you're planning a BRRRR investment, please do not just focus on the purchase financing. We need to plan for the refinance from the very beginning. The right lender, the right mortgage structure, the right strategy can save you thousands in penalties and make it much easier to execute the repeat portion of the BRRRR strategy. And that's what I've got for you tonight.
Thanks, Danielle.
You're welcome.
Sorry about the trolls there.
It's all good. It's all good.
We